All right, guys, in today's video, I want to cover the topic of consolidations in low volatility states and how to play them, how to trade into them, and also trade within them. So right here, you can see, this is a pattern that occurs everywhere. You see a liquidity base here, price volatility narrows, although it's grinding up against a range. That's a very good sign of strength. And then you see the break of the consolidation comes up. Price sets in a consolidation as well, and then you get a narrowing range at top, and then ultimately the market looks for liquidity to the downside. So this is a pattern that is just playing out constantly. You see that here, price narrows here, expansion to the upside, price narrows here. You can see this narrowing range. Of course, it's pretty obvious, but sometimes the adding a trend line to it helps to identify the area. Yeah, so you have this narrowing range. Then price makes a decision, breaks to the upside, get a little bit of retracement. Again, here you have your narrowing range, breaks to the upside, retrace, narrowing range, break to the upside, retrace. And so there's a lot of different ways to play this, right? So if you can play the retracements into this level, and generally there are good areas to look to, take a position or at least look in an area to take a position because when price retraces this inefficiency here and comes down to the base, then it's probably going to offer a reaction. It may not, be a reversal, a bottom formation on the market, but it's probably going to offer a tradable reaction. And that's what we see here. Also, the other way to play it is when you see the narrowing range within, say, an hourly, but, hypothetically, let's say this was a daily chart, and then you can, or even the hourly, you could go down to a 5 minute and trade a 5 minute price distinction within this. And that 5 minute price distinction might help you catch a long position here prior to the break of the hourly range, which is a way to play it within that. And then you can also play the retracement as well. So here's another liquidity base right here. Price enters this narrowing range here, starts to break down there, 618 retracement, sells off. Here's your narrowing range here as well. Again, it's not going to be identical every time. You see, sometimes you see, you don't necessarily see that pattern, but it it is a pattern. Especially if you have a strong consolidation, you'll typically see this pattern, right? So price comes down here, it runs the highs, comes down, runs the lows, or at least runs to this low right here, which you might call a shelf or price pause or something like that. So now your range effectively is here. So it's creating a new range, right? So whereas it was from here to here, now you creating a new range, but then price comes up into the middle of the range, enters a low liquidity state here. Then price makes a decision to search for liquidity to the downside. And now you have well, really right here, actually, this area did not offer a reaction. Let's see. Price enters a very, very low liquidity state right here, ultimately breaks to the upside. Same thing here, breaks to the downside. Again, this is pretty obvious, but I guess the main distinction that I want to point to and illustrate is the idea that these are very tradable levels, especially if the consolidation zone. I particularly like to play retracements into the consolidation, particularly when they're very far away from price. So, for example, let's see. Yeah, so you have this price pause right here. Price enters a low liquidity state, shoots down. Then when price returns, you get a reaction. And you'll probably notice that there's some congruence between some of the other videos uploaded with the point of release and point of origin. Whenever you have a narrowing consolidation range, it's when it does break, it's going to create that point of release, and that'll also be a tradable distinction, and also your clean breaking point. So you'll notice that these areas are, there's a lot of overlap between them because they're all going to come out in the same area, but generally, whenever you have this liquidity base, narrowing range, you're going to have a, you know, a clean break. So price comes down, breaks here. That's a price distinction. You're also going to have this point of origin, but it's entirely framed within the context of price entering that low liquidity state, consolidating, and then searching for liquidity on one side of the market. And essentially, what's happening there when price enters these low liquidity states is liquidity is moving away from price. And that's why the market will move aggressively to search for it away from the current market price. Same deal here. So maybe you have some type of metric to, again, this is something that's very individual, the way you trade it, the way that you pay attention to this distinction. But this is a way to incorporate time into your trading methodology. So every single indicator or strategy or anything anybody talks about in the market, at least a technical thing they talk about, is all some derivative of price, time, and volume. And typically time is something that a lot of people don't really consider or spend time considering. And this is a way to incorporate the element of time, right? So if price comes down and maybe you measure the amount of time price spends in a consolidation, and that might give you an expectation of how far price will move when it does break the consolidation. So you can see how that might have very big carryover applications. If you have a major macro consolidation, say price has been consolidating within a macro range for a few years, well, when it finally breaks the range, it's going to move very, very aggressively, and in a way that will always shocks people, because the longer the consolidation goes on, the more they grow accustomed to that consolidation environment, right? When in reality the coil is tightening and the liquidity is drawing away from the market. It's just another example of how people tend to get caught off guard when the market does ultimately change its state of delivery. Another way to incorporate the element of time is to also trade sessions. So if you aren't familiar with the New York session, the London session, the Asian session, I would pay attention to that. Mark off exactly what time of day those are, and I can upload a separate video detailing that information. But essentially, you want to document what time of day your trades work out. Do they work out in the London session? Do they work out in the New York session? Do they work out in the Asian session? Because certain price distinctions are better tailored to one over the other. And you may notice an interplay between the way volatility expands between the sessions. So if I'm if I'm trading the New York session, I want to pay attention to previous New York sessions, mark them off on the chart. But again, hopefully that didn't confuse anybody. But yeah, if you guys like this type of content, just make sure to like the video and subscribe to the channel.